All right, then I would like to introduce our next speaker, and that is Mitch Sorkin from EisnerAmper. Mitch has been a very generous sponsor of the program for several years now, and he is responsible for all of the accountants in the room getting their 4 free continuing education credits. So nice round of applause for Mitch and EisnerAmper.
Which way are we going? Well, I want to thank everyone for coming here, and I want to thank Lou and the team. And I could just say one thing to you guys. After hearing about all the assemblance of all these great minds, all this planning, it's unbelievable. And to, have to go through a divorce to get there, it's a lot of money. But you know why people get divorced? It's worth it. Just kidding. It also opens up doors. There's a person on the other end called Keep the Vista. He's been around a few times. His last wife is a gem. So one door closes, another door opens up. So hopefully for Marcus and Kim, that will happen to them. So anyway, I just also want to thank Amy Kelly from my firm for helping do all this, along with Beth Wertman. She's unbelievable. She has COVID and we really feel for her. Hopefully she'll get better, but she's here in spirit and she's watching us now. So thank you very much. And I want to thank Charlie Weinstein from my firm, the managing partner, for letting this all happen and make us a participation and provide CP for all the accountants here. So anyway, goals of intergeneration planning. I'm going to diverse a little bit because there's also income tax side. There's also estate tax side. There's other planning, cash flow. It all works together. You got to think outside the box. And that's why you have all these professionals. That's why it costs so much money. So anyway, intergeneration planning, usually you want to minimize your current income and through individual and business planning, you want to accumulate wealth at the lowest tax costs, make smart investments, and transfer wealth to younger generations while minimizing gift, estate, and income taxes. And of course, you want to safeguard those assets. And I just want to make sure you speak to all your clients, make sure they have an umbrella policy. My wife was just in a 4-car accident. She was the last one. So all of a sudden, we're being sued by everybody. And all of a sudden, she goes, Mitchell, I'm going to lose my house. I'm going to lose this, everything you worked for. I said, that's right. She goes, no, no, no. I said, don't worry. We have an umbrella policy. So make sure all your clients, if they have one thing, besides the disability policy and a life insurance policy, which Lou talked about, make sure they have an umbrella policy. So I just want to go through what just happened in 2022. Well, we know I was waiting to finish one of my slides, and that's, oops. And well, I wanted to see who got elected because I have, as an accountant, we've been so busy with all the law changes. It's enough already. So I was praying that nothing would happen. So the Dems got the Senate and the Republicans kept the Senate and the Republicans got the House. Hopefully there's a lame duck session. Nothing happens. I don't want any more work. There's so much planning to go, so much law changes, especially last year when we went through the potential Build Back Better law on all that stuff. So anyway, so what else happened? The market took a big hit. So we have to consider tax loss harvesting on a bond portfolio. I'm looking at my friend, Ben Lehrhoff from Bernstein, and he spins it a very different way. He goes, Mitchell, your client has all these losses. Let's take the losses and they'll realize the capital losses. It's tax harvesting. And I'm saying, Ben, they're really going to lose money. He goes, don't worry about it. It's the same cash flow. I'll buy other bonds that's not like the same bonds. I'll get a higher coupon because the interest rates are higher and they're back to the same place. I said, Ben, they're worth less. They have less money. It took a big loss. Don't worry. We'll get gains to offset. So that's tax loss harvesting. We're coming to the end of the year. The market is down. Look at your capital gains. Unfortunately, you're not going to have all those capital gains from the mutual funds this year, but you might as well take the tax losses. Ben was right. Use it. You can carry it forward indefinitely. unless you die, then you lose it. So don't die, use the losses and against capital gains. Okay, we also have recession and inflation. We don't know what's going on here. I mean, you know what to do now? What do I have money? I don't have money. One day you look at your stock portfolio. Next day it's gone. It comes back the next day. It's always say that to be in the market, you have to be in it or out of it, because those few days that it goes up 1,000 points, you want to be in it than not be in it at all. Okay, higher interest rates, opportunities. You heard Karen, she gave a great chart. That chart is great because it tells you what type of planning you need to do to take advantage of the higher interest rates. And one, she mentioned the CUPR, which is the Qualified Personal Residence Trust. So anytime you play with the government interest rates and they go up, you have different planning opportunities. Here's a good one. How about the school loan forgiveness? This was Biden's best little thing that he came out with. He got elected, he got all his friends elected because of this. All school loans are forgiven. When I went to school, I prized that education. I was happy to pay my school loans. And by giving it all away, I don't think people really appreciate how important education is. I mean, look at all these people here, and you guys are geniuses. I mean, I spoke to many of you. It's amazing how smart you guys are. You went to school, you learned, you worked hard, you paid the tuition, or maybe your parents, maybe you were a trust fund baby, I don't know. But, and anyway, so then an appeals court case came out, they threw that out. So now we're going to the Supreme Court to see whether we can get the school loans forgiven. PP loans forgiven. We all been through that one. That was a great thing in 2021, but we didn't know whether it was going to be taxable, not taxable. Each state had its different situation. But meanwhile, PP loans were an instrument part of it. And if MK Fuel had a loan from that, what happens is they didn't pay any taxes on, their basis increases by that non-taxable income. So that's a good thing. Also, there's a lot more IRS employees. They're coming. They're going to come. You'll see. And here's the best one. How many people listen on the radio? You heard about the ERC expanding to third-party companies say, I can save you. How much? How much per person? $26,000 per employee. I can save you. Right? And you go, yeah. I'm getting calls left and right. Did you save me $26,000? Everyone's doing it. And all these third parties come in. What's going on? I said, well, look, it only qualifies if your sales went down quarter based on 2019, 20, 21. Your comparison, if it goes down a certain amount, one in 2020 had to go down 50%, 2021 had to go 80% differential. So, but the bottom line is this. If your sales didn't go down, you can still qualify for this employee retention credit if you were affected by a government shutdown. So all these third parties says, well, what's a government shutdown? A government shutdown could be, when the New York State says you can't go to work, you can't go into the building, you're not allowed, you have to stop, close your offices. And then there's people or businesses that were exempt from all that. They were allowed to stay open, like a lot of warehouses. So, but however, these third parties have come around and say, well, if the government shutdown maybe affected your supply chain, you can still qualify. That opened up the floodgates. So the IRS heard about all this. It's in the questions and answers. They said, wait a second, it doesn't sound right. If you really don't need the money, why should you get it? So they went ahead and they hired 300 IRS new employees just on this ERC to track this. And they're going after all these people that think they're smarter than the next guy. If it's too good to be true, it's not good. So anyway, so what's happening right now is that you have in 3 years to file these claims. It really behooves you to look at all your clients, even if their sales did not go down, to see if in fact they were affected by a government shutdown along the way. So here's the next one. States enacted pass-through entity level tax, which we'll get to in a minute. But also New York City followed that. Pass-through entity tax is a workaround the state and local tax deduction of $10,000. So what's happening now, all these states that there was a ruling, I think 2001-75 that came out that says you could pay an entity level tax, get a deduction for federal purposes. Okay, wait a second. And not worry about the $10,000 SALT limitation, which is state and local taxation. So all about 22 states were up to now. And we'll talk a little bit about that, but that is major. And New York City just piggybacked that retroactive to the beginning of the year. Then we just had that little thing that passed. We thought it'd be much bigger, but the Inflation Reduction Act came in that said, okay, we got to start paying for all this. You know, it's just like this is Emperor's new clothes. We're all bankrupt. Let's face it, the whole world's bankrupt. We're just a little bit better off than anybody else. So we're trying to raise money without it costing everybody the money. So they came out with a 1% excise tax on these public companies' buybacks and stock redemptions. They decided to expand the R&D credit against the payroll taxes, against not only the Social Security, but the Medicare tax. For the interest of cute little story. So I have a son who became a entrepreneur. He invented a electric marine engine motor. And all of a sudden it's all R&D. He didn't make a dime yet, but he invented it. He got raised $15 million and he hired 40 people and he has all this R&D. And I said, Ben, you know, you can get a credit on your payroll taxes. And he said, yeah, Dad? I said, yes, but you got to pay me to get you there. So he hired me and we got this, the R&D, you can take an R&D against your payroll taxes for new businesses that doesn't have any sales for the last 5 years. So just keep that in mind. It's a very powerful tool and they raised the ante on that. So you could take up to like $500,000 a year on it. Okay, so let's go on. Oh, I guess we're gone. Okay, so we did this and okay, so let's look at the inflation adjustments for a second, and then we'll get into MK. Okay. Okay, Social Security. Does everyone know it's going up? It's going from 147,000 to 160,200. That's about $818 per person, per employee who makes that much money. And then the employee also has to pay that. That's a lot of money. And that's going to hurt an MK Fuel. It's going to have their costs are going to go up. I remember when I started working, I was like $13,000 and I was in. But now it's up to this, and there's no limit, of course, for the Medicare. 401k, this is a powerful one. It's going from 20,500 to 22,500 with a catch-up going from 65 to 7,500. Catch-up of people 50 and over. IRA contributions increased from 6,500 to 7,500 in 2023. The rate tables expand, so you pay assuming less taxes, and you have a standard deduction that also is going to go up for head of household, joint, and singles too. The AMT, which we're going to see again right after all these crazy laws from the 2017 TCJA, gets phased out again. But the AMT exemption is $81,300 for singles, and that gets phased out, and it's higher for joint and head of households. But that AMT still comes in a lot of times if you have long-term capital gains. So you got to watch that. Here's a good one. Every employer, including MK Fuel, should get their employees to try to get that fringe benefit of $300 for the Metro cards. So it's a direct reduction in your, yes. Oh, I'm sorry. Yeah. So you get the direct reduction. You can travel, transportation, that you help the employees come to work because it's getting expensive. I don't know about you. I have people that drive to my office and the fuel cost is out. It's out the door. I mean, wait until they knock on your door and want raises. You'll see. The FSA, which is that flex spending account, it's going to $3,050. Anyone that works for a company that has that, grab it. It's worth it. You could pay your medical bills from it, your drugs that's not covered. I wonder if cannabis is covered now. That's a good one. That'd be a good one. I like to see how I could put that through because that's big now. Anyway, just dating myself. Estate and gift equivalent, we went through that. That's increased. Annual exclusions are going up to $17,000 a year in 2023. So you got to take advantage of that. Okay, MK Fuel. We talked about the ERC. Okay, you got the 3 years. You got a 3-year look back to make sure you're covered. So it's worth. Someone has to look at all the 941s and all the whether they can get it or not. Here's a good one: accrual to cash basis. What's that? Well, normally you're on accrual basis if you have inventory, but MK, let's say, is on the accrual basis. They could actually convert to a cash basis because their average sales were under $26 million. Why would someone do that? If their receivables are higher than their payables. So if you're on a cash basis, you don't recognize your income until such time you collect the money. All right, everyone talked about the transfer of ownership to the children. The idea is we're dealing with Marcia, I guess, more than anyone else, because she's the one that's going to take over the business. I'm ahead. Oh, sorry. So everyone talked about how we get Marcia the stock and everything else. And the issue is also she's the one that has the IP. So a lot of people, what they deal with is outside of everything you heard from an accountant's point of view, we always, these ideas are great ideas, the preferred, the non-convertible, the SARs, everything you could think of. However, a lot of people just say, well, why can't Marcia just set up her own company? It's called creeping acquisition. Slowly but surely, she transfers the IP, grows her own company. It gets higher and higher and higher. And then you say, what else could she do? Could she take an R&D credit? She has all these advantages now where she can own her own company. Tell Marcus, we're going to get your estate down because I think, as Karen said, at the end of the elephant in the room, they still have a large estate tax. What are we doing? And as we took a lot out of the slat, but we still have an asset that's appreciating in value. However, keep in mind too, any sale of a patent, which he has, is no longer capital gains, it's ordinary income. So be careful of how you do that. 1202 option, we're going to talk about that in a few minutes. Retirement plans, we talked about some retirement plans. Look, Marcus is older, he can have one of these defined benefit plans and put hundreds and hundreds of $1,000s away. Very important. New York employers, okay? You know what the rule, effective January 1st, anyone that has more than, I think, 5 employees has to have some type of IRA or pension plan. Very important. You have to do that. And New York is supposedly coming out with a plan for that. So just realize that. Tell your clients they must do that. And there's, as long as they have been in business for 2 years, there's maybe some exemptions, but normally, unless an employer has a plan, they're going to probably be fined. So just be very careful on that and tell all your employers and clients. Research and development credits. I told you the Ben story. The biggest thing that happened on this R&D is that it used to be 100% deductible. So we used to get 100% deduct. You can't imagine if it wasn't depreciable in nature, it was deductible, and you get the credit. Credit comes out to about 4% of all the increase in research and development. It's a lot of money. It goes right to the bottom line. It's a credit as long as you're not subject to the AMT. And what was really funny, I found out that the reason they capitalized this now, you have to write it off or amortize it over 5 years now. If it's foreign research, it's 15 years. Now, you guys got to start doing the calculation from Empire to see whether it's worth to still capitalize and take the credit or take the current deduction. So you have to look at that because now that it's capitalized, you want to rethink everything. Not everything becomes research and development. I have clients that say, I made my own Excel worksheet. research and development. I'm creating new software. So this is very important, especially in MK Fuel. They're doing a lot of research. They had this whole new technology. It's all research and development. So they should definitely take advantage of it. But, you know, they passed the law to amortize it over 5 years so they could keep the C corporation rate down at 21%. That's the only, besides the alimony, that's the only thing that's permanent. 21% C corporation is permanent. Everything else goes away. Okay, other considerations. Yes,
Or get a preferential. Patents are a type of IP that gets a preferential tax rate, am I correct?
yes,
Yes. So you're suggesting that Marcia retain the IP in a separate entity, am I correct?
I'm saying that Marcia forms her own company.
The company,
She could
for her
purchase,
sister-
she could purchase her IP or transfer it into it. But I'm,
can she not lease it to MK
yes, she could lease it.
and retain it herself too?
Yeah.
And that would keep it out of Kim and Marcus's estates.
Yes, you would get a reduction, sure.
Yeah.
There you go. Okay, so what could MK do? This is important. It's an LLC. And we want to be able to elect the PTE, the pass-through entity tax regime, so we can get a deduction. LLCs by itself, single member LLCs, you cannot take the PTE. I'll repeat, you can't take the PTE if you're a single member. So you have to make this LLC somehow a partnership. We talked about, I think, Lou talked about changing interest, getting the kids involved. Anything that to make it into a partnership, you'll be able to get that PTE deduction. And it's major because it's at 37%. So every dollar that you pay on behalf of the corporation, a company that relates to any profits or capital gains, you'll be able to get a deduction at the 37 deduction rate, which is, it's a lot of money. For New York State, you had to have done it by 9/15. Since we're an LLC, MK Fuel is out of luck for this year, but maybe for next year. So the idea is it's important that one of the planning is either making it into a single member, a partnership, or maybe you do an S corporation, which we really didn't talk about it that much, but you can always convert an LLC into an S corporation, and then you don't need more partners or shareholders. Sales tax issue. I want to bring this up because this is a major, as you know, the Wayfair case started this whole thing with Nexus. So every state jumped on board, and unless you're living in, I think, I guess the biggest one is Delaware, where you don't pay sales tax. Anyone that sells, these online retailers, they sell into a state, all of a sudden, they're subject to sales tax if they're over a certain threshold of sales. So everyone jumped on the bandwagon, and then all of a sudden, they're taking it to another level for this word nexus. Nexus is what makes you subject to estate taxes. So what happens is nexus is different for each state. Maybe it could be based on volume, could be based on employees. What's happening now, Washington, Oregon, and Ohio have these business privilege tax. Even Nevada has one. So those states now are saying that you're no longer covered by this public law 86-272, which gives people the right to avoid doing business in a state if they ship in from outside by a common carrier. So all of a sudden, this whole thing is gonna, skyrocket. California says even though you're protected by 86-272, we're still gonna charge you taxes or a minimum tax, or even subject to the income tax or corporate tax based on your level of doing business. And now they have this thing called cookies. So if you're an online retailer and you sell online and there's a cookie, you accept the cookie, that means you're doing more than mere solicitation. You're gathering information, and they want it subject to doing business in California. So you got to watch out for it. So MK Fuel, they do business and they ship to a lot of states. They have to look at everything that where they ship to and see where they're subject to sales tax or corporate taxes or individual income taxes. QBI, that's the 20% deduction. That's still around. That's going to go away too. Don't worry. But it allows them to take a 20% deduction on their income on their personal return. However, as an LLC, if you pay yourself guaranteed payments, the wage limitation for purposes of the calculation is not included. That's why sometimes a lot of LLCs become S corporations because they need to build up the wages on that. So it's important that as an LLC, you might be limited on this 20%, but MK Fuel probably is making a lot of money, has a lot of employees, and therefore you don't have to worry about that. Okay, and then we have business income not subject to the net investment income. As you know, if you have a company that's a trade or business, it's not subject to the 3.8% Medicare tax. However, the Build Back Better law was trying to subject everyone to this 3.8%. So you're going to have to watch out. They're all going to come back. These are going to be revenue raises situations that are really coming quickly on all this stuff. So that's some additional considerations on that. Okay, so some more things that to be aware of. We have the just be aware that the business interest, I mean, if you get a loan from Contour, if they need a loan, that not all the interest may not be deductible because of the limitation of this 30% of adjusted taxable income. So be very careful when you take loans, all the interest won't be deductible, but it gets carried forward. Bonus depreciation, especially in the MK Fuel business, they should buy as many assets as they can because it's still 100% deducted. If they're making that much money, they can go out and buy a plane. That'll be 100% deducted too, if they use it more than 50% in their business. That bonus depreciation is going to go down. It's going to go down to 80, 60, and then it's boom. But Section 179 is still around, which is you're able to deduct up to whatever the limit is as completely deductible in 1 year, similar to bonus and all that, but it gets phased out. New York State has an investment tax credit, if you didn't know. New York State, if you buy machinery and equipment used in the manufacturing process or even research and development, you can get yourself 4% credit based on the cost of those tangible personal property that you bought. So if Marsha's going out and buying all this equipment that she needs, she can get a 4% credit on that. However, you can't take 179 depreciation on that. You have to take bonus. But New York State doesn't allow the bonus, so you have to use a longer life, but it's still worth it. 4% credit is a lot of money that they can get. And we talked about all the property that they own. The property that they own is the real estate they had it in Brooklyn and they have it in Tarrytown. So if they own the property, make sure they pay the real estate taxes by themselves as part of their lease. It's got to be in the lease. They get a credit on the real estate taxes that they pay. It's they get a 20% credit. So if they pay $100,000, they get a $20,000 deduction to New York State credit, but they have to reduce their real estate taxes by $20,000 in the example. So just be aware of that property tax. However, when we started talking about land, I had Elu put that in the case because I didn't want them to own the land, because I want to make sure that if they rent land from a third party, they can still take the real estate tax deduction and credit. If they own the land, they basically, and they lease it to themselves from a related party, they would not be able to do that. So you have to always think outside the box and see what's available for all the things that we can take. The Brooklyn property, it's always in an inflationary period, it's always good to own real estate. I'm a proponent of keeping real estate. You can always go to Contour, mortgage it, you can rent it out as opposed to just selling it. We talked about different ways of selling it. You sell it, you get capital gains, it's 20% plus you don't have to, we can say it's still used in their trade or business and try to avoid the 3.8%. If there's any depreciation recapture, it's at 25% on depreciation recapture. And hopefully, if it's passive though, you pay the 3.8%. We talked a little bit of like-kind exchange. They can go out, sell it, buy 3 other pieces of property, give it to each kid if they wanted to do and not recognize gain. We touched about on the qualified opportunity zone. The problem with this, you're a little bit late to the game on this because you have to hold it for 10 years and any appreciation will not be it won't be taxable, but all the increases in basis has kind of been phased out. And then you only have a window of like 5-6 years, and then you still got to recognize it. So the qualified opportunity zone is not what it is right now. Plus, New York is not following it. They talked all about the CRATs, structure the LLC to be taxed as a partnership. We talked to that so we can get the PTE. The transfer, this is interesting, and all the lawyers should know this now. Transfer of the Brooklyn property. If it's part of an agreement and it's in the agreement, say I hereby transfer the property all to Kim or Kim to Marcus. Believe it or not, there's a freaking New York City transfer taxes on that based on the value. I didn't know about it until it happened to me in a divorce situation. So anytime you want to transfer property, make sure it's not in the agreement, make sure it's done before the divorce has taken place. So you get around this transfer taxes. You'll be surprised. You get that little letter because you got to fill out that RP, what is it, 490, what's that, RPT tax? So be careful of that. And also, okay. Okay, I just want to briefly talk about working from home. A lot of people work from home. The question is, if you're working from home, could you in fact not pay taxes in New York? So I have like Peter Cutton is working from Georgia today. He's at the seminar. And the question is, if he's attached to the New York office, he's going to have to pay taxes as if he's working in New York. So you have to be careful of where people work. A lot of times we tell our companies to open up a little WeWorks office in another state or rent the home office from the employee, but then they have to do business in that state. Each state's different how they do telecommuting, but the New York State is after you. If you think you're going to work in Florida, live in Florida and work out of your New York office, they're coming to get you. I want to talk about the conversion of the 1202 deduction. You probably heard a lot about this. Why didn't you tell me about the 1202 deduction? 1202 deduction basically says that you could avoid capital gains tax equal to 10 times your original investment or up to $10 million. So you say, wait a second, you mean I can sell my company and not recognize any gain? That's right. But you have to be a C corporation. So if MK Fuse wanted to explore this, usually this might be for Marcia. So what she would do is set up a whole C corporation and build it up, and then in you have to hold it for 5 years. You could basically shelter $10 million of gain from there. It's a little different for Marcus because if he converts it, his basis or the value of the time he converts it, that's how you measure the gain. So it's not that effective with him. But you see more and more people doing this because the corporation rates are still 21%. So they could build up, they can sell their stock in a C corporation and walk away with a lot of money. I just want to mention that if MK Fuel is selling overseas, they could explore what they call the interest charge this, which basically converts ordinary income into qualified dividends in essence. And then we do a little sleight of hand. We have it owned by a partnership and then qualify for the PTE. I know I'm saying a lot and I'm running out of time. So let's talk about Marcus changing domicile to Florida. Yeah, they could work from home, but you got that 183 days outside of New York. Plus you actually have to work in Florida and live there and change your domicile. And that's an audit situation that you go through. I want to point this out in the fact pattern, they have all these Roths and IRAs. a lot of what we used to do when we do divorce planning, we used to tell the husband to give the wife the taxable IRAs. So he wouldn't have to be taxed on the income and give it to his wife. You know, when you have a Roth, there's no taxability, even though it's all subject to the estate taxes. When the market goes down, I'm getting calls left and right, and they're saying, why don't you take the Roth? Take your current IRA and roll it into a Roth. Pay the taxes now, and you have more chance of an appreciation. That's a calculation of how old you are and how much taxes you have to pay, because you still have to pay the taxes. But rolling it into a Roth basically would actually reduce your estate, because you got to pay income taxes on it, and then you have room for appreciation. And when it gets inherited to your beneficiaries, they don't pay any income tax. They have 2 kids, maybe try to put them on payroll. But remember, when you put them on payroll, you still got to pay that Social Security tax. So I don't know how much of savings they had. Insurance planning, if I don't mention this, Harvey Feinberg would get upset at me. Consider private placement insurance policies. It's a great investment vehicle. I have clients that put private equities into their private placement and made millions of dollars, and it's not subject to income tax. And if it's done right, it's not subject to estate taxes. So something that Harvey's here if you want to talk to him about that. Okay, Harvey. The next one is alimony. Even though alimony is no longer deductible or income, New York State decoupled. That's what no one told you yet. So New York State does give you a deduction, and it is taxable. So be careful on that. Okay, Social Security. Since they're going to get divorced, they're married for more than 10 years, the lower income spouse could collect 1/2 of the other spouse's Social Security. Divorced spouses may collect from their previous spouse Social Security if they're married for 10 years. When one spouse dies, the other spouse may collect the other spouse's Social Security if it's higher. Something to work out of. It was funny. They mentioned that they sent Kim to get a job at Guggenheim. I remember I was in a divorce case, and the husband convinced his wife to go get a job. So when they finally went to get divorced, she was an income earner, and that affected the calculation of the equitable distribution and how much alimony she gets and all that other stuff. Okay, if you walk away with one thing, walk away with this. People have co-ops in New York City. Okay, co-ops in New York City have a lot of real estate taxes. Okay, the way the SALT is limited to $10,000. However, for co-ops, the deduction for real estate taxes comes through on a letter. It's a 216 deduction. It's not a 160 code section 164 deduction. So if you want, so in the Build Back Better law, they knew there was a problem. The Technical Corrections Act never addressed this issue. Even though in the Blue Book, they said that it's the intention of Congress that the real estate taxes on a co-op should be part of that $10,000 limitation. Okay. A lot of people saying, well, what if I don't do that? What if I take that deduction? So it was a whole big thing about whether to take that 216 deductions. So a lot of people advised to take it. A lot of people advised not to take it. So I always like to push the envelope a little bit. So I took it for a client, and we got examined. And we won. But it was interesting. The way we won it is the government said, we have no further issues with your return. We accept it as filed. So they didn't ever address the deductions, because even in the Build Back Better law, they said we're going to make sure that 216 is part of the SALT limitation. However, it's not going to compromise us from going back and changing what we did. Anyway, I know I moved fast. I know there's a lot of things here. And if you have any questions, I'm here. Thank you.